Welcome everybody to Module 9 of our boot camp. Today we're going to be talking about financial statement presentation and surplus cash. Thanks to our sponsors, as always, for helping us put on these great boot camps. And thank you to Gail and Rita for helping to make them better and better every time. We really appreciate all the work you're still putting into this. If you're looking for CPE credits, please make sure you submit all the polls throughout the session. We do use the polls and the Zoom attendance record to verify that you've been fully participating the entire time. So if you notice your display name is not correct, then send me a chat message so I can correct that. If you have any questions at all about CPEs, you can send me a chat or feel free to email me. If you have tech issues as we're going through, including if you have any issues submitting the polls, send me a chat message. If you can send me a chat right away, then I can use that timestamp to show that you were participating during the poll, even if you've missed submitting it. If you have any content questions for our presenters, please also use the chat feature to submit those. And we will pause to answer questions throughout. There'll be a break as usual midway through, and you can unmute your line if you'd like to ask questions aloud during that time. Of course, during the breakouts, we encourage everybody to have their cameras on, and that's a time for you to discuss a class exercise with your peers. So in the chat, I've shared the usual materials link. That's the same one we've been using throughout the sessions. Today, we will need to refer to number 15, which I'm pretty sure is a PDF of the limited partnership agreement, and specifically the surplus cash section on page 71 is where we'll be focusing. Also helpful related to this session are 17 and 18, and it's noted here which pages in handout 17 are most relevant. And I think that is it. Oh, and I'm noticing that actually we have an error in our time here on this page. Originally this module was 2 hours, but we're actually an hour and a half today. And now I think that's it for me. So I will hand off the screen sharing to Rita. Thanks.
Okay. Thanks, Lindsay. Everyone can see my screen? All right. Good morning, good afternoon, wherever you are. Thanks for joining us for Module 9. As usual, we go through what we have learned so far as we continue in the life cycle of an affordable housing project, of a LIHTC project. In Module 1, we identified our deal, which is Restoration Housing LP, and we learned how to account for earlier grants that we received. It can be a loan, contribution, or exchange transaction. We talked about different types of entities and when to use which, either a nonprofit, a limited partnership, or a limited liability company. We dove deeper with the deal structure in Module 3, and we learned all of the deal participants, and there's a lot of them. We talked about the qualified allocation plan, which set out the state's eligibility priorities and criteria for awarding federal tax credits. And we dabbled a little bit with some low-income housing tax credit calculations. And we talked about the state determination letter, which is a letter from your state agency that tells you how much is the federal tax credit awarded to your housing project. In Module 4, we went over a sample financial projections, which is a tool that you send to your prospective investors in order to attract them to invest in your project. We also discussed matters that are important to developers when selecting an investor when you receive those letters of intent from different investors. In Module 5, we talked about construction accounting and best practices around funders requisition. In the next module, we went through every line on the cost certification and some best practices in preparing for one. We also talk about IRS Form 8609, which is an IRS form that tells you how much tax credit for each building. In Module 7 is the first module where we were transitioning to operations. So we talked about all the documents that we need to be familiar with and certain sections in those documents that are important for us to know. Last week, We continued with operating issues and we focused on accounting issues. We talked about different kinds of fees, especially related party fees and different ways of presenting sponsor loans. We also discussed best practices in accounting as far as operations is concerned. So today, which is module 9, Gail will introduce us to what we're going to be talking about.
So here we are, module 9, 8 down, 3 to go. Congratulations so far. So today we're going to talk about what happens when we end year 1. And when you end the year of your first year of a tax credit deal, you have financial statements to present. And we're going to show you what the deal financial statements look like. That's the middle bullet there, partnership or limited liability company financial statements. We're going to show you what those look like. We're also going to show you what nonprofit financial statements look like. Some of you may already know this, so we apologize if it's already old hat for you, but some of you don't. And so we wanted to just show you a little bit of the difference between the two. And then we're going to start to talk about surplus cash, which is my favorite topic of the whole presentation. So we're going to start today with surplus cash. Next week, we're going to have, or 2 weeks from now, next week's Thanksgiving. So we won't be meeting, but we'll be meeting the week after. And so in that session, we'll be really getting into surplus cash calculations. So I know that's what you've all been waiting for, but it's really taken us all of this time to explain to you what you have to go through from the very beginning of the inception of a potential transaction all the way through now. Here we are, we've now finished 1 year of operations and we're talking to our auditors and they are auditing our entity, producing financial statements and helping us with our surplus cash or waterfall calculation. You're going to hear both of those terms used, so we kind of like to give you both. So we're going to do our first poll. So who within your organization plays a role in the preparation of the financial statements? And there's really no wrong answer here, but there is a best practice. Any of you 12/31 year ends are starting to think about this, right?
Yeah, definitely. It's already November.
Hey, Lindsay, the drama. Drum roll, please. All right, most of you said it's your CFO or controller. 2% said program staff and real estate development staff, and 29% all of the above. So again, no wrong answer, but I really like all of the above. And the reason I really like all of the above is because different folks in the organization know different things about what's happening. So in your financial statements, you have to talk about guarantees or maybe maybe you've committed to something in the future that you need to disclose. Your executive director might be the only one who knows that. So really, it's a best practice to have everybody involved. So certainly the CFO controller are preparing the first round, but a good practice would be to send it to your ED. Hopefully most of you are being asked for that now. If not, that's a good conversation to have. You also want your real estate staff to take a look at it because in the footnotes, we're talking about each one of the real deals. If you have only 1 or 2 deals, there's probably a footnote for each. If you have 100 deals, there's probably graphs and charts to try to capture the data because it's certainly not going to be deal by deal. But essentially, you're looking to make sure that any risk associated with those real estate development deals is appropriately disclosed in the financial statements. It's really important to get that right, particularly for the audience that we're serving, which are our lenders, right? So funders, perhaps. So all of the above is the best answer if you can get to that place, but certainly CFOs and controllers, that is one of our primary job functions. So on we go.
Okay, on we go. We said we're going to be showing some sample financial statements, and let's start with a sample financial statements for a nonprofit organization. And I'm going to show you what we have. Can everyone see it? This is a big charity. Let me go to
Not very creative, whoever came up with this sample. Big National Charity Inc.
Yes. Okay, so Big National Charity Inc., it's a not-for-profit. And let's go through some of the things that's peculiar to a nonprofit financial statements. Again, some of you, maybe most of you have already seen this and are familiar with this, but we'll try to go through it together. All right. So let's start with the statements of financial position. Sometimes it can get confusing because it's called differently. This is actually the balance sheet, but if it's a not-for-profit, you call it statement of financial position. One thing that you would notice in this financial statements is it's unclassified. So you don't see current assets and non-current assets. It's just going through from cash to property and equipment. And this is acceptable with GAAP. This is okay to do for as long as you list them in order of liquidity. So you start with cash and cash equivalents and you end with property and equipment, which is the most illiquid, and that's okay. But you will also find in your organization that maybe it's a classified statement of financial position where you list all of the current assets first. You have a current portion of your notes contributions receivable. You have everything else that's current is included in your current assets. And then you have non-current assets. The same is true for liabilities. This is not classified, so you don't see that here. But if it's a classified statement of financial position, you would see accounts payable, current portion of the related party payable, and anything else that's current. And then all of the non-current liabilities. One thing that for sure you'd probably already know would be the thing that's very peculiar with a nonprofit financial statements is the concept of net assets. And this is because a nonprofit organization does not have equity since it doesn't have any ownership. Nobody owns a nonprofit organization. I think in previous module, we talked about if a nonprofit will have to fold up, they have to look for another nonprofit with the same mission, and all of the net assets of that nonprofit will go to that other nonprofit that has the same mission. It doesn't go to owners because there's no such thing as ownership in a nonprofit organization. So net assets are broken down into two: without donor restrictions and with donor restrictions. I'm not sure if you remember, but a few years ago, this used to be three different types of net assets: unrestricted, temporarily restricted, and permanently restricted. There was an ASU that came out, and that ASU says, okay, it's now not anymore three, it's now down to just two. So temporarily restricted and permanently restricted, they're included in this line with donor restrictions. It's important to note that if you have board designated net assets, similar to the past standards, it goes in this line without donor restrictions. Even if it's restricted or designated, it's an internal designation. It's your board who's making that designation, not a third party, not a donor. So even though it's designated by the board, it still goes in this line without donor designations.
So before you leave this statement of financial position, for those of you who don't prepare these, when Rita says classified, meaning we split the assets into current and long-term, we split the liabilities into current and long-term. What makes an asset or a liability current is whether it's payable or collectible within a year from the date of the balance sheet. So if you don't expect to collect a receivable, for example, for 2 years, that would be classified as a long-term asset. You would have accounts receivable long-term because it's not going to be collected within a year from the date of the balance sheet. That's correct, right, Rita? It's from the balance sheet.
Thanks for mentioning that. That's correct.
So, and the other thing we talked about last time was construction payables, because they're going to be paid with a long-term source, long-term debt. They could technically be classified as long-term liabilities also. I think that theory depends on who your accountant is. So please do speak with your accountants about that. Some folks still say, well, it's still payable within 30 days. And so it should be current, but I, having been through this for quite a number of years, believe it really should be long-term. So just another point.
Yeah, I agree. If it's not going to be paid by your current operating cash, then that goes into non-current.
So it's really important to think about who's reading your financial statements as to whether you classify or you don't classify. Because if you don't do it, somebody else will, and they're going to guess. And I can guarantee you they're not going to guess as favorably as you would like them to. And if they're calculating your ratios, right? Current ratio is current assets and current liabilities, and they're guessing as to which of your assets are current and which of your liabilities are current, I can guarantee it's not going to be as favorable. So I'm not a huge fan of unclassified financial statements for exactly that reason, because I want to be in control of what my ratios say. I don't want some third party to be in control of what my ratios say.
So back to the net assets, just at some point I want to mention here, you would only see a line for without donor restrictions and also a line for with donor, but usually there will be a disclosure that gives more details, especially with this line with donor restrictions, because you wanted to know what the restrictions are. And usually it starts with the beginning balance and then how much you added to with donor restrictions, and then what have you released, and we'll see that later. Okay. Moving on to the statements of activities, which is your income statement. Again, it's called differently for a not-for-profit. It's statements of activities. And what you would see here that will jump out is these columns. You have a column for without donor restrictions and with donor restrictions. And this is very peculiar to a not-for-profit organization. You don't see this kind of thing in any other entity type other than not-for-profit. So also the net assets released from restrictions is also something that is only for not-for-profit organizations. So when you receive contributions that has donor restrictions, it goes to this column, and then you release it when you've satisfied the restriction and you move it to without donor restrictions. And we're going to be talking about expenses in the next slide, and Gail will walk us through this. But this is essentially what's different in a not-for-profit organization's income statement versus what you would normally see. Essentially, this column is what you would see in a for-profit income statement. But with a not-for-profit, you have this other column with donor restrictions. Okay, let's go back to our slide and see if there's anything here that I've missed to talk about. Okay, we're ready for our second poll for the day. Does your organization have more donors with restrictions or general donors without restrictions for the use of their donation? What do you have? Do you have more donor restricted donations or donations without donor restrictions in your organization? I think everybody loves the second one, more donors without any restrictions on the use of funds. I'm not sure if that's what everyone's getting. We'll see.
It's really hard to find unrestricted capital.
Yeah. Oh, yay. 57%.
You.
More donors without any restrictions. That's really wonderful. That's great. Okay, thanks for answering that, Paul. It brings us to our next slide, which is expenses. Gail?
Yep, so nonprofits have an interesting convention in terms of disclosing expenses. And it's only specific to nonprofits. So nonprofits on the main statement of activities, which is again equivalent to an income statement, we actually show costs grouped by program, not by type. So when I mean type, I mean salaries, wages, office supplies, computer expense. It's grouped by program, and we're going to show you that. And so you would have, depending upon how many programs you have, and we're going to have a poll question about that. If you have 5 major programs, you're going to see 5 lines on your statement of activities. If you only have 1 program, like we just saw in the sample statement, it was just 1 line item. In the notes, so either as a supplementary, as another statement, not supplementary, as another statement that could go behind the statement of activities, or in the footnotes, there's something called a functional expense statement. And that is where you actually break the expenses down into the types of expenses that they actually are. So you would have each program running across the top of the schedule, and the type of expense running down the side of the schedule. And it should total and be matching with what you show in your statement of activities. So management and general expenses and fundraising are 2 categories that cannot be commingled with program. They're very specific categories that need to be shown discreetly. And so almost everybody has some type of fundraising expense, some type of fundraising activity that needs to be disclosed. And then certainly management in general. We've recently had a little discussion about what's a healthy M&G percentage of total expense. I don't know what you guys think about that, but used to be that the rule of thumb was, gosh, you didn't really want to have more than 10% of your total expenses be management in general, because our donors want to make sure that all of their dollars are being invested in the actual programs that the organization has run. I will tell you that current thinking suggests that that is too low a percentage, because it really takes good infrastructure to run successful programming. And so I think the trend is up from that, and that it's okay to be 15-20%. You know, it's a fine line, of course, but I do think that conventional wisdom of 10 is no longer in style, and we are really understanding what it takes to run a well maintained nonprofit. And nonprofits get criticized most heavily about not investing in infrastructure, that we think we have to spend every dollar we have on programs, and we really fail to manage the company. And so the lack of infrastructure spending is highly criticized. If you attend any nonprofit conference, it's usually one of the main topics that you ought to be spending on infrastructure. So that's that. And then as Rita already told you, there's no statement of changes in equity, which you would see in a for-profit statement, because nobody owns it. So there's just simply a statement of net assets, which net assets means take what you owe what you own, deduct what you owe, and what you're left over with are your net assets. It's just a very simple math equation.
Right, and do you want to show, Gail?
You want to pull those up?
Yeah.
Okay.
So let's start with this, the statements of activities, and then I can go to the functional
Yep.
expense.
All right, so just take a look at the expense line item. You'll see we have only 1 program. It's called Animal Services, and we spent $4,286,000 on animal services. Then you'll see management in general and fundraising. That's an interesting fundraising number. It tells me they do a lot of fundraising. If you think about that, 20% of what they're spending is fundraising. So if you flip down to the statement of functional expense, you'll see that now we're showing the expenses by type, right? So you'll see that we actually provide grants to other agencies who might do some of the work, subcontract work for us. We pay salaries and benefits. We have education classes that cost us money, occupancy, depreciation, and so on. And so if you take a look, that total should still be the same 4.286 that you saw in the statement of functional expense. But now you can see the expenses. You can see what we're actually spending the money on. I think this is, in my opinion, much more meaningful than the statement of activities, because you can't see what they're spending the money on, right? Like, I would love to see this statement of functional expense replace the statement of activities, because we can see both the programs and what we're spending the money on at the same time. But this was added a couple of years ago. You used to not even have to have this a couple of years ago, and it became a requirement, which anybody should, in my opinion, should have been doing it anyway, because you can't really tell what you're spending the money on. So it's pretty straightforward. It's pretty easy to see how they both tie out, and we show a comparative format. And so you can tell a lot more about the organization and how they operate, right? You can see that in 2020, or so in the bottom year, they spent they didn't subcontract out nearly as much as we subcontracted out in the current year. So it'd be interesting to read in the financial statements, maybe why that was. I'm just trying to understand the business. You'll see professional services, which was much higher in the prior year. So maybe we were paying consultants to do the work that we're now subcontracting out, right? So I get fascinated by this stuff because this is the stuff that tells you, talks about the business and what are they doing and how are they getting it done, right? To me, this is kind of why I ended up, I hated accounting in high school, by the way. I swore I would never be an accountant because it was so miserable in high school. And I got to college and I looked around for the gut professor because I know I'm not going to be an accountant. I'm going to be something in business, but I'm not being an accountant. And they switched out the professor. And he happened to be a guy who worked for Ernst & Winnie. And he was a young 34, 35-year-old guy. He brought his clients' financial statements into us, and he told us stories about what these companies were doing before he taught us the accounting. And I, from that, said, this is what I want to do because I really want to understand the business. I'll get to the accounting, but I want to understand the business. So he was just so successful in converting a few of us who swore we would never be accountants, but here it is. So to me, this is the hot part of this where you get to really understand the business. So I think this to me is the most meaningful statement. Hopefully y'all have this in your financial statements.
Yeah, that's a wonderful story, Gail. It's the first time I heard that. Okay, so just some additional comments on the statement of functional expenses. GAAP requires that there is a disclosure on how you're allocating, what your allocation methodology is amongst these different functional expenses, how much gets into your animal services program, management in general, and fundraising. And I just want to show what it looks like for that disclosure, how it looks like for our sample nonprofit here. So here in note 2, functional expenses, they've outlined how they're allocating different kinds of expenses, and their method of allocation is either time and effort, square footage, or full-time equivalent. And so I've seen a lot of, I don't usually see it done this way in a table type, but you could also do it this way. But the general requirement is you're supposed to disclose your methodology. And you'll see that in every not-for-profit financial statements that you look at. I do also want to mention that Gail mentioned that the functional expenses for Big National Charity Inc. is another statement after the statements of activities. That's one option. You can also do notes to financial statements, but you are not allowed and you're prohibited to include this in a supplementary information. It's not allowed to be in a supplementary information. It can be a separate statement or notes to financial statements.
Right.
Okay, let's move on to, I think, Gail, this will be the
I
next
think we
one.
have a poll, right?
Yes.
So does your agency have more or less than 10 programs listed on your financial statements? You might not know, and that's okay.
Less than 10.
Okay, 17% of you said more than 10, 62% said less than 10, and 21% of you don't know, and that's okay. Although I would say to you, go ask for your financial statements and take a quick look at them because it'll help you understand your organization as a whole. Financial statements are a great way to sort of see big picture what all you're involved with. So for those of you who have more than 10, oh my gosh, that's a lot. So I would almost say maybe you're too granular in your financial reporting, and maybe you're too spread out in terms of what your organization is trying to accomplish. It's hard to read financial statements that have more than 10. You know, you think about what you would think about an agency that's got 10 substantial programs. They must be a really big agency, or they've got people spread really thin, right? Trying to accomplish so much.
Mm.
So if you have more than 10, it would be good for you to know why that is. And is it really that you have more than 10, or should you be grouping some things so that the financials are a little easier to understand?
Okay. We're moving on to partnership or limited liability company. But before we do that, there's something I want to mention about big charity. I just want to mention, because this is something that you will find when you look at not-for-profit financial statements. And this is new, maybe became effective, if not 2018, 2019. And this is something that a lot of people actually like to read, something to do with your availability and liquidity and availability. This is not, this didn't used to be required by GAAP, but starting, I think 2018, 2019, now you would see this disclosure in all of the not-for-profit organizations' financial statements. You're required to show quantitative information on the financial assets available to meet general expenditures for the next 12 months. Both quantitative and qualitative. Qualitative meaning, how are you managing the liquidity risk? So for big charity, this is their disclosure for availability and liquidity. And you'll see this in every nonprofit financial statements. Okay, so back to our slides. And now we're on partnership or liability, limited liability company. And I'm just going to show you an example that we have, which is our sample deal, which is Restoration Housing. So this is Restoration Housing's financial statements for 2017. We obviously start with an index. This is a HUD project, so you would see the financial statements, the basic financial statements, and you'd also see supplementary information that's required by HUD, this being a HUD project. So let's start with the balance sheet. Oh, I do want to mention, since I'm here on Independent Auditors Report, this reporting, Independent Auditors Report, will change. So for those of you nonprofit organizations that has June 30 year end, you must have seen a different auditor's report. But for 12/31, you'd see it maybe for the first time, where the opinion, this opinion usually is at the last part, last section of the auditor's report. You will see that when you look at your December 31, 2022 audited financials, it'll be right here at the top. So there's a and then it's going to be really longer than this, because all of the management responsibilities will be included. All of the auditor's responsibilities will be included. There's nothing changed with how we're doing it as an auditor and what your responsibilities are as an auditee, but now it's going to be included in the auditor's report.
I think that's a great reformatting. I think I might have told you guys that I have taught a class on financial statements for a group of lenders who underwrite deals, who wanted to know more about what they should be looking for. And I would tell you 3/4 of them didn't even know what the audit opinion was telling them. So they couldn't tell you, they didn't know if they were actually even getting an audit or a compilation or review. They didn't know to look for that. Imagine. So, you know, a review is much less detailed audit work than an detailed audit is. And a compilation is simply somebody taking your numbers and formatting them nicely. They don't look at any backup at all. So a compilation really doesn't do much for you. So when you're reviewing financial statements, first thing to look for is, what did I get? Did I get an audit? Did I get a review? Or did I get a compilation? Because it makes a big difference. The second thing to look for is the opinion. And so now it's not going to be at the bottom, it's going to be at the top.
Yeah.
Is it a clean opinion?
Yeah.
Right. So it was fascinating to me to teach this class, and I saw all these wide-eyed look. People were like staring at me. I said, well, what's the issue? Well, we don't really look, we get right to the numbers and look at the ratios and like, oh, well, I can understand that, but you really should start at the top. So it's really I think it's a great suggestion to have the opinion reformatted that way, Rita. So thanks
Right.
for sharing that with us.
Yeah. Okay, so this is the balance sheet, which is the equivalent of the statement of financial position in the nonprofit financial statements. So you would see our Restoration Housing LP's balance sheet here. And what you'll notice is that's a classified balance sheet. It starts with current assets. And then all of the other assets that are non-current. Similar to the not-for-profit, it started with cash, which is the most liquid, and it ended with property and equipment. Or other more illiquid assets. For this entity, they have other miscellaneous assets. Same with the liabilities. It starts with the current liabilities. And then everything else that's non-current. And one thing that's different is the partner's equity, because there's ownership in the partnership compared to not-for-profit where there's no ownership. You have partner's equity of 10.8 million in this example. Now, sorry, going back to the balance sheet, you'd see it like this, which is the usual that we've seen. But some other financial statements, they follow real estate format, and the real estate format starts with the rental property. So you see rental property here towards the end because it's based on liquidity, order of liquidity. But in a real property format, they start the balance sheet with the rental property, the first line item. And to them, those that require that, that's the most important asset of a housing financial statements. And so they would have rental property first. And in the liabilities section, they would have the notes payable first, because the notes payable is what was used to pay for the real estate property. And we have audits where the investor limited partner has that format as a requirement. So we have some projects that we audit where it follows the real estate format. So it's not required by GAAP, but some investors prefer it. It's just good to know, because you might question, why am I doing it like this? That's not what was shown in the bootcamp. Okay, statements of operations, which is the income statement. This is a housing project, so obviously you'd see rental revenue. And then vacancies to arrive at the net rental revenue. This format is very, it's almost templated. You would see this kind of format in most of the affordable housing projects. And these are the expenses also. This is almost templated. You would see the same way each time, every time you look at an affordable housing project. You have administrative expenses, utilities expenses, operating and maintenance, taxes and insurance, financial expenses, and then all of the other expenses, non-cash depreciation and amortization, and the below the line related party expenses, which are included in the net entity expenses.
So sometimes you'll see this detail in the back as a supplement. You might see only the major line items like taxes, insurance, financial expense.
Yeah,
I have seen that as well, but you absolutely need the detail. When you go to look at surplus cash calculations, you need to know what's in these numbers. You absolutely need the detail.
yes,
So
that
this is probably
correct.
the best presentation in terms of providing you with the information you need to know.
Right. So again, because this is a HUD project and you'd see a supplementary information towards the end that is required by HUD, which has very specific account numbers. They have very specific format and what to include in what account. And you would see that here.
So the good news is most of the audit firms, this is part of their system. So it's mapped, they map the trial balance one way for the GAAP financials, and it maps it a second way for the HUD financials. So you're not doing this.
Yeah,
But
that's
it's
correct.
good for you to look at it to make sure that everything's pulling up properly, because, you know, things happen.
That is right. So it's time for our 10-minute break. It's, what time is it?
Quarter of the hour.
Quarter, yeah, to come back at 5 minutes to the hour. Yeah, okay,
Yeah.
all right. We'll be here
Okay,
in
if
case
you want-
anyone has any question.
When you're talking about, not mixing financial data and all the other kind of stuff, and it doesn't quite strike a note with me because, and I don't know if we're oddballs, but when we start a new project, whether it's a rehab or a new build, most of them are rehabs, we get ready to set up a whole separate accounting system, a whole separate entity. And as soon as we receive the LIHTC determination, provided that we got it, we then do all of the accounting for that project in that separate entity. It's consolidated at the end of the year in our audit and our financials, but it's all kept separately. Is that an odd way to do it, or?
No, that's definitely an option. So the only thing you have to understand is that you're going to start incurring costs before the entity that the investor is going to enter, before that gets formed. So you're going to be incurring costs during some pre-development phase before the actual entity gets formed. So you can vary, but what you can do, which is what I do, is create a dummy company in my accounting software and pretend like a new entity was formed. And
Okay,
so
yeah, we kind of do that. We make sure that all of the separate costs associated with the project, the pre-development costs, like we like to call them, where those are all segregated in our financial, in our parent company financials, as you could call it. And the program program manager or project manager also does the same thing. She keeps track of all of those costs separately, so that when we do actually get the LIHTC and we do actually form a whole separate organization, all those costs gets transferred in and put in the right location.
well, yep. So there's multiple ways to get there. And so it sounds like you have a process as long as you're segregating costs. I literally know a very large company that had one CIP account and literally put all the projects went into that CIP account, and they did not have a job cost system to segregate them. So the important point here is don't commingle costs from one project to another. You really want to make sure you have a separate system for that. So you can, if you want, set up a dummy company. Like I set it up in my accounting software and I call it the name of the project. And then the chart of accounts is all set. And then, so if you remember what I told you, I loan money in from my parent company. I set up a bank account and I use my parent company's tax ID to set up the bank account for this project. And then I loan money into that bank account from my parent company, and I let that project spend the money so that it's tracking all of its own costs through its own bank account.
Oh, okay.
So because it's so hard to do it after the fact, right? So if you're keeping some ancillary system, at some point you got to dump it all into the GL and pretend like to get it to be a real company. So in my opinion, why not start out that way? But that's not, other people have job cost systems and they're perfectly comfortable monitoring projects through a job cost system. I personally feel like it's really hard to track if you're using one bank account and you've got multiple projects running through it. It's hard to find things sometimes.
Oh, we got way too many bank accounts.
Yeah, and there's that. And maybe you would say, I'm going to have a separate bank account for all my development projects separate from my parent company operations. You might do that. In my opinion, the more detail, the better. Like So once you get audited, right, like just think about what you're saying. If you now are being audited, you're having your cost certification done, and you have to pull a proof of payment. If your internal controls are not being tested and you're being they're actually auditing you as if you don't have an internal control system, which a lot of small companies, that's kind of how it works. You're pulling bank statement information for your auditors. That's really hard to do if you have multiple projects, bank statements that go on for pages and pages and pages because you've got so much activity running through it. So there's no magic answer. It's, you've got to kind of figure out the sweet spot of, am I creating too many GLs and too many bank accounts, or do I not have enough? And it's just a matter of how you manage it. So we
Yep.
have, you know, 4 or 5 projects. I'm quite happy to have 4 or 5 bank accounts to make sure that everything stays discreet. Because in the back end, when you're finishing your project, oh my gosh, you'll be so grateful you did that. Just so much easier to figure out what happened.
Yeah, in our chart of accounts, we have a separate segment that allows us to segregate all of the expenses that go to all of our different projects, and even more than that too. So we usually try and make sure that that's part of the all of the input. So I can then say, okay, if I need all the information on that project that was put in through our general accounting system,
Mhm.
give me everything that has this number in it.
Yep. So it's, so you can manage it through your main general ledger. I guess, again, at what point does your general ledger get to be too big and too hard to manage? Right? If you're running all that stuff through. And you also do want to make sure that your GL accounts on your projects match up with the GL account, with the line items in your projections. And, you know, remember way back, like in module 2 or 3, we were looking at financial projections. You want to make sure you use the exact same labels as are what in the projections, so that there's a trail that people can follow.
Yeah, that makes sense. Okay. That's my question. Thank you.
Oh, sure.
Hopefully everyone's back. And as usual, we start with a checking in poll.
So here's our favorite one. Did you learn anything today that you know will impact your work? And it can be no, because maybe you're just learning, you're not there yet. This is really just to make sure everybody came back.
And we'll keep it up just a couple more seconds and then we'll get rolling.
Yeah, thanks, Lacey.
Okay, if anybody missed the poll, just send me a chat message.
Okay. So now we're getting into some introduction about surplus cash. You've heard surplus cash over and over again in all of the other modules. And we've actually gone through a discussion about our sample deal. It's waterfall. So just to remind us about what do we mean when we say waterfall. So waterfall is exactly this: priority distribution of surplus cash. And I think the reason why it's called waterfall is because it cascades. You start with the first priority distribution, and then the second, and then the third, through however many you have in your operating agreement or your partnership agreement. But just to show you what we have in our sample deal, Restoration Housing LP, and I have the handout number 15 open to section 10.1, which is the distribution of priority distribution of cash flow. And we've seen it, I think last module, where Gail went through each of the waterfall, each line item in the waterfall for Restoration Housing, when we were talking about related party fees last week. So we don't necessarily have to go back and read through all of this. Just know that there are fees that are cumulative or non-cumulative. cumulative meaning you can accrue it and it's paid to the extent of surplus cash. So even if there's no surplus cash, you should still accrue. And fees that are non-cumulative, you will only accrue it when there's surplus cash available to pay for that fee. And for restoration housing, I think we've determined last week when we were going through each of this priority distribution that supervisory management fee is a non-cumulative fee where you would only record it when there's available surplus cash to pay for it. And just like Gail said, it's probably not going to happen until, I don't know, whenever, because you're probably not going to get to this level of the priority distribution because some of the other ones that needs to be paid are tranche B, a sponsored loan, and these amounts are huge. And so in order for the project to get to pay tranche B and sponsor loan, I mean, before they get to the supervisory management fee, that will take a long time. Okay, and then if you look at the, sorry, I just want to show the financial statements one more time. And look at what they have as far as, so you would look at the priority distribution in the partnership agreement, but you also can refer to a note in your financial statements that talk about the waterfall. And that's usually note, this one, note 8, which you will notice that the priority distribution that you'll see on the financial statements of restoration housing and the priority distribution in the partnership agreement are exactly the same. And that's good for this project, but not all of the projects would just copy the partnership agreement and that's how everyone else will be okay to follow. There are a lot of instances where your lender's agreement, and if you have several lenders, they have their own version of how to calculate surplus cash, and your partnership agreement has their own version of how to calculate and how to distribute surplus cash. And in most cases, it's not always the same. So what do you do when the partnership loan and regulatory agreements contradict each other? Let's go back to the slides. So what do you do when it's contradicting? And I find that it's contradicting most of the time. There are very few cases where you can just get the partnership agreements priority distribution and that's the one that everybody will be okay to follow. Doesn't happen all the time. Usually everyone is fighting on what's their surplus cash and how to get to that number. So what do you do when it's contradicting? What we've seen that happens is sometimes the project would try to come up with one that will marry all of the contradictions and then have everyone approve. And so there's just one that is being followed. That happens in some projects, but in some other projects that may not necessarily be the case. Especially, well, I'm saying this from the experience we have with the city and county of San Francisco or other state lenders in California. They're very specific about how they want the surplus cash calculated and what they get in so far as distribution is concerned. And so what usually happens is the project will have to calculate it in many different ways. However, many lenders and or partnership and other at stake entities that would like to have their own calculation of surplus cash. The sad reality is sometimes that's just how it is. So what's your experience with this, Gail?
Yeah, so this part of the reason we gave you this particular case study is because it's a very simple surplus cash calculation so that you're just learning the concept. But Rita's right, it's seldom this simple and there's always another lender that wants you to do it differently. So particularly city or state lenders, they seem to think that they should have their own calculation. And it's interesting because sometimes it results in them getting less cash than they would have had they followed the calculation that we use otherwise.
I agree.
But with that said, I have to tell you, I have been doing this for a very long time. And whenever I provide a calculation to a state or city lender or to anybody, I never get pushback. So I've never had anybody come back and say, hey, we don't like, we compared both calculations and we don't like what you did. All they care about is that you did it the way they wanted you to. It's like a check the box thing, no lie. So if you check the boxes and you send the financials to the lenders when you're supposed to, and you send them their own calculation of surplus cash, and I have an example I could probably send around to show you in just a different format from one of my state lenders. It's amazing, but that is kind of what you need to do. And if, as long as you're on a timely basis and you're not raising any red flags, people seem to be just happy they got a check. Right? The state is honestly just happy that they got a check because they have a lot of deals that don't cash flow. So if you're sending them some money, they're probably not going to bother you. So the point here is you do have to use due diligence, talk to your auditors, figure out how you're going to approach this. Once you pick an approach, stick to it. And as long as you stick to it, generally speaking, you're not going to have an issue. But Rita's right. It's more often than not that they're different.
Yeah, and there's some lenders, state lenders, city lenders, that they're very adamant with how they want their own calculation to happen.
Mhm.
Okay, so so
let me just make one more point. What you will find is, and Rita's going to talk about this before we get to this poll, is that HUD takes a balance sheet approach to surplus cash. They look at what you have on the balance sheet. Most often our state and city lenders take an income statement approach. So they're only looking at the income statement. They don't look at how much you might have on the balance sheet. So because they don't look at what you have on the balance sheet, they get a different answer, right? Because you could have used cash to buy fixed assets, or you could have taken in more cash, have a lower receivables balance than you would have otherwise. All those balance sheet changes make a difference. So in general, that's typically what you see, is that the other lenders take an income statement approach, whereas HUD takes a balance sheet approach. So you get slightly different answers. You just do. So
Right.
Sorry, Rita.
No, that's fine. And we have a separate, after the poll, we're going to talk about that. Okay. So before we talk about that, we have our fifth poll for the day. When should you calculate the amount of surplus cash and who it is distributed to? So when should you be doing that? After the audit is completed and you're certain of the amount to be distributed, as you get closer to the year end and you can estimate, or the year prior with an estimate for the surplus, so that you know you have some understanding of the impact on cash for the year, and so that you can budget for any fees that you will earn, or all of the above. I think we had some discussion about this in prior module as well, where we were whether you should do the surplus cash calculation yourself, or you should get the auditors to do it. And I think the best practice I mentioned is it's best if you do that from your end and then have your auditor review it. But then the question is, when is the best time to do that? Do you wait for the audit to be completed, the numbers to be certain, and then you make the calculation? Okay, so most of you, 53% of you, answered all of the above. So which means you do an estimate for the year prior, which is good, and then you can budget however much of the fees that you could get. But then also, as the year get closer, you would check the estimate that you have done, which is good to see if it's still realistic. That's great. And then after the audit is completed, that's when the final numbers are. Then you look at it one more time. I like that. I like all of the above.
So if you know your property's not going to cash flow for sure, you're just going with the top answer, which is after the audit's complete, because there's no point, right? So for those of you who answered A, it could be that that's why that you're not used to seeing some surplus cash. If you are counting on surplus cash, if you have a property that cash flows every single year, and I do have that, I want to know what's coming in the door, and I want to know it like last year when I want to budget for it, because I don't want it to just show up and say to my board of directors, yeah, I didn't bother trying to figure that out. We just get what we get every year. Like as a CFO, that's probably not an appropriate answer. So I really do try to make an estimate of it, and then I take a haircut on it, because who wants to budget too much? Nobody. So I'll calculate it and figure out what I think the number is, and then take 10% off of that and say, okay. And I'll tend to budget conservatively, but I think the absence of a budget for a property that you know is cash flowing is just, you're not probably putting the effort in that you need to. So I would just sort of think about that as you look at your deals, which one of them are worthy of your time to sort of think about how you might budget for that.
That's true. Okay, Gil, I think you started in it earlier.
Oh yeah, sorry, I jumped ahead.
Oh, no, go, no, please go.
All right, so,
Good.
yep, so there's two approaches, right? And your partnership agreement or operating agreement, if you're an LLC, generally takes an income statement approach. And the most important thing for you to know is that you'll always find the waterfall steps in section 10.1 of every agreement. It's amazing how they've all been standardized, but almost always the way to calculate them is found in the definitions section of your agreement. So you'll see the word surplus cash, and they'll be capitalized S, capital C. And that means you need to go back to the definition section to figure out what that is, how to actually do that. So if you're trying to figure this out, you will need both the definition section and the main body of the partnership agreement to understand how to do that calculation. And sadly, on the income statement approach, almost always they only let you use revenue that you've actually collected. So they will not let you include accounts receivable, but they force you to use expenses on an accrual basis, which is, I think, quite unfair. I really don't like that approach at all, but you'll find that that's the case. So revenues on a cash basis, expenses on an accrual basis, to give a conservative approach. So that's what you'll usually see in the operating agreement. Some states do the same thing. They'll look at an income statement approach. They will, however, factor in fixed asset additions. So they're not oblivious to the fact that you have to use cash for fixed assets or for principal payments on debt. They usually will factor that into the end, so not to worry. But typically it's an income statement approach with some balance sheet stuff tacked on the end. HUD always has a balance sheet approach, which I like. And part of the reason I really like the balance sheet approach is that in any given year, you could have cash for some reason that comes in that didn't run through your income statement for some reason. So maybe you have a capital contribution that came in and it runs through the equity section of your financials. Or maybe your property wasn't cash flowing on the income statement approach, but there was cash accumulating on the balance sheet. It's now trapped on the balance sheet. And if you're only looking to current year operations to tell you what you can distribute, you have no opportunity to distribute any excess cash that might be sitting on the balance sheet. And I've had that happen on a couple of deals. So, you got to think hard about how to work your way around that. And there's some tricks to all of that. But in any event, if you're looking at the balance sheet, you're actually looking at what you have in cash, right? And that's really what's available to distribute. So if you take the income statement approach and you forget to look at your balance sheet, and you forget that you made a bunch of fixed asset purchases, or you forget you had huge debt service, you could end up calculating a number that exceeds what you actually have available in your bank account. So most of us, there's a few folks who do this sort of sophisticated reconciliation between the balance sheet and the income statement. We're not going to go through that. I don't do that myself. I do look at it for sure to think about what is the difference. And the other thing you have to understand is you're doing this off of your year-end financials. So let's say you're at 12/31. The cash on your balance sheet at 12/31 may vary significantly from the cash on your balance sheet in April when you go to make this distribution. Think about that. So you may have the right to distribute, but if you are taking cash out of your property and leaving it with no ability to continue to make repairs and maintenance, you're going to have a problem down the road. So really, be very thoughtful about that. When you go to do this, you do it on the 1231 numbers, you look at how much cash is available for distribution, then think about it. And I have left distributions behind for this very reason, that I have the right to take a distribution, but I'm not going to take it because the property has such small replacement reserves. It doesn't make sense. So here's the other nice thing about that. You could actually go to some of your city and state lenders and say that to them and say, listen, how would you feel if nobody takes a distribution? We're both entitled to it, but boy, I'd really rather put money in the replacement reserves. Almost always they will do that with you. Because at the end of the day, they are just trying to create affordable housing. They are not lenders who are looking to make a buck at lending. They are lenders who are looking to make sure that you're producing affordable housing. They're mission-based. So they would much rather have you shore up the property and make sure there's cash there to do repairs and maintenance than take a distribution that they may not be expecting anyway. Even though they're allowed to take it, they may not really be expecting it. So don't be afraid to get to know your lenders and have those conversations. And I've been very successful on a couple of my deals saying, listen, we really need to put money into replacement reserves. We have this big repair coming up. Are you okay if nobody takes a distribution? And so I've been really successful at having that discussion. So remember, your lenders are just people, and most of them lend, not your permanent mortgage. Those people are in the business to make a buck lending. So they're not going to have too much sympathy for you. They're not going to let you not pay the asset management fee or the mortgage, right? So, but the sub lenders are in business to create affordable housing. They're mission based, and so most likely they will work with you if you have a deal where you think it's best to keep the cash in the deal. I know it's very sad when I have to come to that conclusion, but in the long term, I think it's the right way to manage the property.
Yeah. One more thing I want to reinforce. I think you already mentioned this, Gail, but I just want to reinforce that what you said earlier. When you're doing the balance sheet approach for HUD projects or any other lenders that would require balance sheet approach, it's important that you exclude any cash that you need for other purposes. So if you have cash earmarked to pay your developer fee, cash earmarked to purchase fixed assets, or anything else that is earmarked for other purpose, make sure that you take them out of operating cash. Because when you do your surplus cash calculation for HUD, whatever is in the operating cash account, that's the amount that's available. And Gail's going to show you a sample calculation in the next slide.
Okay, so we're going to pull up the surplus cash calculation for restoration for 2018.
Okay. For 2018, okay.
Yep.
Okay, let me just go through that.
Okay, so here's the calculation. This is the HUD calculation, and it's in the financial statements. It's in it's section F5. Why do I know that? Because this is the first piece of paper that I look at when my auditor sends the audit financial statements to me for review. I flip right back to the surplus cash calculation. Okay, how do we do? So if you look and see, you'll see that HUD counts cash accounts. They also count security deposit accounts, which seems odd to me because down below they reduce it by the security deposit liability. But so it's kind of in the top and the bottom, it washes out. And then they will also let you include receivables that are due from them, not tenant receivables, because they don't know if you're going to collect that, but they sure know that they're going to pay you. So always anything that's due from HUD in terms of subsidy would be allowed in the calculation, because for sure they're going to pay you. So that's your total available to be paid. And then we look at what our current obligations are that are not already reserved. So if you have a reserve for real estate taxes that you're going to pay real estate taxes out of, you would not include accrued real estate taxes on this calculation. You have a reserve that you're going to make your debt service payments out of. For some reason, you have a debt service reserve. You would not have principal payments on your mortgage debt included in this calculation. You're only going to include things that are due within 30 days. due within 30 days and it's not reserved elsewhere, okay? So if we look at what's on our balance sheet for liabilities, we've got some accrued interest payable. The fact that that's there tells you there's no debt service reserve, right? We don't have delinquent mortgage payments, thank God. We don't have delinquent deposits for replacement reserves. We do have a few payables that are due within 30 days. So that's a good point. How are your auditors going to know that? Right? They're getting into the weeds. So if you're doing the calculation, you're going to know that. And you can put a schedule together to show them how you came up with that, right? So no loans, no deficient tax. We've got some accrued expenses that are not escrowed. You'll see that. Prepaid revenue is included as a liability because technically it's due back to your tenants if they were to move out, right? And then I just told you that tenant security deposits, the asset is up above, the liability is down below. They pretty much wash out. So I don't know. I always thought that was kind of silly, but there we have it. And so if you take your total cash and you deduct your current obligations, you can see that we have $240,000 this year to distribute. It's very exciting. Right, so you technically should be able to find all of these numbers on the financial statements. And we're gonna do that next time, where you're gonna try to come up with this calculation all on your own, taking the financial statements to figure out what you think the numbers are. Right, and we'll probably have to give you some hints if I remember correctly. We give you a few hints because you can't necessarily know what's there, but that is the HUD calculation.
Yeah.
That makes sense to everybody? So again, it comes off the audit, but I audit the auditors because it's my cash. So I audit the auditors. And every once in a while I find something, not all the time, but every once in a while I find something that helps my position. So, so it's worth your time to go through and do that. I think we had as a handout the financial statements, but that's for you for next time. That's for you. You will need those next time. I think we're going to have you calculate 2017. And so you'll need the financials. So we're going to our
Last ball for today.
last poll question. Woo.
Yeah.
Does your agency rely on surplus cash from your properties to fund program costs? So yes, it does. No, it does not, which would be awesome. Or I wish that our properties had surplus cash to distribute. Some of you may be in that boat.
Hopefully not. Hopefully you have surplus cash.
And if you don't know, and you want to know which of your properties are given cash to the agency, talk to your accounting department, they'll know. Or your asset manager needs to know, he'll know, or she'll know. %15 of you, I'm so sorry. So we'll have to see what we can do about that. So it's pretty evenly split between yes, it does and no, it doesn't. So those of you who don't rely on it, congratulations. I do think there are quite a few nonprofits that do. And one of the strategic plan initiatives ought to be, let's find a way not to rely on that. That should be really for put away for special events, special something, and not relied on year to year, because it's not a year to year distribution, right? It may not be. So really tough to rely on the surplus cash to fund your program costs. I think that's it. Thanks so very much. We are always so happy to see you all come back, which is wonderful. If you could just complete the evaluation that Lindsay's put up for you, you need to do that if you're expecting to get CPE credit, which is why I do it every time, because I'm expected to get CPE credit.
And we'll see you not next week, week after next, after Thanksgiving.
Right.
Time flies.
Yeah, it goes fast, doesn't it? Like you first think, oh, it's 11 segments, but they go pretty quick, don't they? At least we think they do. I don't know. Do you guys think they do?
For sure.
Me too. I was surprised. It's already module 9 today. I'm like, oh my God, just 2 more left.
You guys will all be pros and you can teach everybody at your organizations, right? You can give them the course. Happy holidays, Richard. Thank you so much. Enjoy your Thanksgiving. I hope you get to spend some time with your family and friends and really enjoy seeing folks. It's been a couple of long years with COVID, right? So some of us are finally getting back to being with family and friends, which is really such a blessing. So happy Thanksgiving. And we'll
Happy
see you.
Thanksgiving,
Thank
everyone.
you all. Happy Thanksgiving as well. Take care. See you in a couple.
Bye.